I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, thanks for having me back, Jim.
Ted, you're going to do your Monday outlook for Canadian stocks. What are you looking ahead for?
Well, we were really interested to see what was going to happen with Jerome Powell's speech that took place on Wednesday. The reason being is due to the volatility we've seen in the markets, and everybody was wondering, is he going to be the fireman Fed chair who basically puts out the volatility fire that we've had in the market, or was he going to throw a bit more gasoline on the fire and continue to talk like he was a hawk and continue with his tightening path? And he sort of, on balance, looks like he's got his fireman's boots on. I don't know if he's got his hose in the hand right now, but he seems to be strapping up and getting ready to sort of try and maybe help the market out a bit here. We still don't know for sure, but basically what he said, Jim, was that they thought they were pretty close to the so-called neutral rate, interest rate, where the economy wouldn't be, where interest rates wouldn't be pushing the economy to be too hot or constricting it to be too cold. And he then went on to describe how beautiful shape the U.S. economy is in, is that it was essentially not too hot and not too cold. Put two and two together, and you can say, maybe the Fed's only going to hike rates once, maybe twice. I mean, that was kind of the takeaway from a lot of people in the market. The problem with that is that enough? You know, is that enough? And certainly we saw a huge relief rally in stocks on Wednesday, and they're trying to make up their mind today in terms of whether that was enough. So we could be here right now in kind of a testing pattern. Also, you know, waiting for fundamentals to really assert themselves. Is there really underlying demand here for equities beyond the share buybacks? You know, are we going to start seeing positive earnings news, prizes, pre-announcements, surprises on the upside? You know, so probably not. You know, we're on that front. We're late in the year, but you know, I think markets are looking for direction right now. They've got all they're going to get from the Fed in terms of comfort. So, you know, it's going to be, I think, still a tricky time for investors over the next few weeks, at least going into the Fed meeting where they may give some more clarity. They'll have even more data on the economy. But so basically what we put out for CanadianInsider.com readers today was four goalposts, signposts actually, that we're looking at in the market to kind of get a sense of whether we've had a durable bottom or, you know, at least a significant floor in this recent pullback. And basically, we're at 50-50. We're looking at four factors, and it's on our website, CanadianInsider.com. People can look at the blog post of the Fed backtrack enough on rates. Essentially, we're not seeing confirmation from our Canadian Insider Index. It's still lagging the TSX 60. Why is that important? Well, during during uncertain times where investors are fearful about the global economy and the risks, they tend to move to large cap stocks, the 60. While you see and it's quite normal during these growth scares to see the 60 outperform the mid cap oriented Canadian Insider Index. It's still outperforming, so we don't really have an all clear there. The second point we're looking at is our indicators, sentiment indicators, our insider indicators. Have we seen peak insider buying in the U.S. and Canada? Not yet, so we don't really have a confirmation there that we're in. But on the positive side, over the last month, value stocks have outperformed growth stocks, at least in the United States. And financials have been leading, which is really important. However, today, the financials are lagging. So we have a kind of 50-50, or maybe at least one out of the four is giving a pretty clear positive signal as the value stocks. The financials, let's say for now they're confirming that we're back into a bit of an upswing, but insiders are not confirming that. Our index is not confirming that, and as I mentioned, the financials, it's looking a bit iffy. So we're not out of the woods yet by any stretch of the imagination. We're going to need more time to see if stocks can have formed a base here. Our thinking is on balance. It probably haven't, but look, if we start to see these indicators, these signposts point up, then that'll be great. We'll be back into rally mode. So next few weeks will be very interesting. A lot of noise, tax loss selling, along with people buying opportunistically of a lot of oversold stocks in the market. So I don't know if you're going to get a lot of clear signals over the next few weeks. We're probably looking into the new year before we can really get any conviction behind any kind of sense of direction here.
We'll have more with Ted Dixon right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ted Dixon. Ted, if there's only one or two more Fed hikes expected to U.S. interest rates, what does that do to the U.S. dollar, and how does that affect the price of gold?
Well, that is the multi-million-dollar question for gold stock investors. It should be the question on everybody's mind who's investing in the market right now, because the gold sector is long forgotten by most institutional investors, and your listeners are probably much better acquainted with the gold market and gold stocks than 99% of the global investing community. Now, why this is important, and Mike Swanson had a great piece earlier this week, and we've actually linked to it in our blog, Did the Fed Backtrack Enough on Rates, where his point was, and we agree with him, and it is totally consistent with the work that we've done, that if we're at the end of the interest rate cycle, or as we get close to that, meaning, once the Fed has stopped raising rates and now is looking to probably, the next move is down, that is you want to be exposed to the gold sector, the gold group, around that time. You don't want to be waiting here until after the Fed starts to cut rates. By then, you're getting late into. You're going to miss a good part of the gold rally if you're waiting for that. It's too late. What you got to do traditionally is anticipate when the Fed is stopping. So, in our view, the setup for the golds continues to be pretty good. We had heavy insider buying, Jim, back in October. the most we've seen since the summer of 2015. And what happened in the summer of 2015? Well, we saw a major low in the gold stocks, coming down from that huge rally they had in 2011, and then they went into this horrible downturn. Then we saw this peak insider buying in 2015. Saw right around lows in the gold stocks. Gold stocks have recovered since then. They've gone up, they come back down, but they haven't gone back down to those lows. We saw a big burst of insider buying. And what has that preceded? Well, here's some really important developments that I don't think the market's paying much attention to today, but it's something really that everybody should be keeping an eye on. We may have put a bottom in jobless claims, that is, in the U.S., that is, people filing for employment benefits when they lose their job. So it looks like that may be turning back up. Well, that would be a complete change in the narrative for the job market, because all we've heard for the last couple of years is how tight the labor market is in the United States and how they can't get enough people to fill the jobs. If you start seeing jobless claims going up, that means people are losing their jobs. It's not a case of voluntary unemployment. It really means there is a slowdown in the job market. So now it could be a blip. We could have had just a couple of days of blippy data, maybe too early to tell, but there was a fairly decent jump today. We'll have to see. We also may have a top in the CPI, at least for now, thanks to the collapsing crude price, and even core CPI in the U.S. looks like it may have peaked. And I say for now because I'm not one of those in the camp that believes we're heading for a big deflation. Maybe we will be, but in any event, if we are at the top of the CPI for now, what it does, it gives the Fed cover to stop raising rates. I mean, the Fed will use CPI for its own purposes. They'll twist the narrative to whatever, and same with the Bank of Canada, not just the Fed, central bankers in general. They'll give you the story that fits. So if they really want to keep raising rates, they would just say, well, this plunge in crude is just transitory. But if they want to stop raising rates, they'll say, well, we have to stand back and see what's going on here. Maybe the plunge in crude is signaling something broader in the global economy that we want to take a look at. So I suspect the latter will be opted for by the Fed in the new year. And the other major development that we're keeping a really close eye on is have we seen a top in real rates in the Treasury market, because it's very hard for gold to make headway when you've got momentum for real rates going higher, at least when they're going higher for the right reasons, a growing economy. So we didn't get a pop in real rates on the back of recent Fed speak, so that is also positive for gold. So we've got a very nice setup here, for those who've been waiting to commit to the gold market or who are maybe a little fearful right now. Now's the time not to be fearful, but it is the time to be watching to see, are these indicators continuing to go in gold's favor? Look, we could have a snapback. The economy could come roaring back here in the next few weeks, early January, and that would put all these indicators in reverse for gold. So, it's not like the ball's being hit out of the park here for gold, but the setup is very nice.
We'll have more with Ted Dixon right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, the Alberta government says it's going to buy 2 complete trains to haul tanker cars around to bring more oil to market. Is that a good move on their part? Because it seems the debate over pipelines just never ends.
Well, really, they're doing they're trying to pull a rabbit out of the hat. They're just trying to do anything that works. The whole situation is pretty pathetic, and what else can they do? They're trying. Unlike Ottawa, they're trying. And and it is their job. It is the Alberta government job to try. So, my concern about that, though, is how will it impact the rest of the logistics in Canada for other industries? So you're going to put more trains. Do we have the capacity? I don't know the answer to that, but that would be my one concern. Is this going to crowd out forest products and other intermodal and other industries that need the rail system? So governments have really made a mess of it here. It's completely a made in Ottawa problem. It's their pipeline policy, it's their environmental policy, it's their consultation policy and execution of that policy that has messed things up. And it's just sad that we're resorting to these kind of stopgap measures. That it reminds me of the grain days when the governments had to buy grain cars because the wheat board was such a non-market oriented entity that it messed up things, in terms of fundamentals. So, of course, and not just the wheat board, by the way, it was beyond that. It was because of the freight rates that were all part of the deal. You had this sort of massive government intervention in the grain market, made a total mess of it. And here, it's the opposite. You've had sort of government incompetence and government hostility towards the oil patch. So it's really been this clandestine war against the oil patch by Ottawa, and a degree of incompetence as well, because I don't think the Harper government at all was hostile to the oil patch. Their heart was in the right place, but they just weren't able to get the ball across the finish line because there's a lot of forces in government whose heart is not in the right place when it comes to the oil patch. So I'm sure they were continually undermined every step of the way, but nevertheless they were unable to get things across the finish line. They did get a number of pipelines built within Canada, but that's great. But these products still have nowhere to go when it comes to getting it to Tidewater and to foreign markets. So. They're doing what they can, Jim. But this will get worked out eventually. There will be a solution. The oil patch. There are a lot of companies in the oil patch that are trading at big discounts that have all been. That a lot of bad news has been priced in. Could it get worse? Sure. But for those who are willing to do their homework, there's some companies that are still being able to generate cash flow dividends, and if you have a longer term horizon, now's a good time to get looking at it. However, I'm using the word look. I put a shopping list together, and if you really see irrational selling, particularly during tax loss season, you may be able to pick up some really good energy, oil and gas names on the cheap here. But I would really look for bargains. I don't think there's any rush. But when you do see a tax loss, hit on a company that you think is going to live the fight and stand another day when the oil price bounces back, then there could be some good, decent, buying opportunities around Christmas. So those who are inclined to stay around and do some bottom fishing at the end of the year could be handsomely rewarded.
Woodfibre LNG has just come to a $1.1 billion agreement with the Squamish First Nation. Is that the right way to do business? Make sure the Aboriginal population is happy with your project before you start making noises and putting shovels in the ground?
Well, if you're in the resource business in British Columbia, you have to have a First Nations strategy, and I think every situation is different in the sense that depending on where you're operating, the realities on the ground with the First Nations can be quite different. And it's probably though a reflection that this company has done its homework, I would assume. And what you don't want to do in British Columbia is not do your homework. I think British Columbia gets a lot of bad reviews because of environmental and First Nation issues. But you know what? really very few jurisdictions in the world have no issues to worry about. You always need to get an environmental permit. And yes, the First Nations situation can make it more complicated here. But if you have a strategy to deal with it, not only will it help you get your project done, but it will also help you make the right business decision whether you should do the project or not. Some projects may just not be a go, right? But you have to find that out sooner rather than later before you spend shareholder money on a project that's not going to fly.
Is it good news for BC LNG that South Korea is building another 140 LNG Super Tankers?
Well, it's good news it's good news for British Columbia, that the project is moving forward. There is global demand for LNG. It's just whether we can capture it. And the story is unfolding fairly positively. So, when you talk about the gloom in the oil patch, it won't be long, Jim, before the narrative on natural gas in Canada turns positive. And again, by the time we're talking about how good it is, here on this broadcast, it is probably too late to make really good money in the natural gas stocks. But right now it's a kind of a gloomy period. Do you want to move in at this point? Well, if you see something on sale that's got good exposure to the LNG Canada project, and when I mean exposure, that will benefit from gas being taken away from that part of the area in Western Canada where natural gas is produced, now is probably not a bad time to be looking at some of these stocks. Some of these stocks have been hammered along with the oil stocks. And, there's been some volatility in the Canadian natural gas price. Well, 2 years from now, it should be a completely different story, as it should. There's always risks, but it's moving in the right direction. Unlike the Trans Mountain Pipeline, unlike Energy East Pipeline, unlike Northern Gateway, I've listed 3 pipelines off. That list went from bad to worst. Okay, so oil has got many more challenges in Canada than LNG. So now's not a bad time. Again, if you start seeing some of these stocks being clobbered on tax law selling, this may be one of the last times to get them on the super cheap in the natural gas space.
Ted, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca, his website, CanadianInsider.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our popular YouTube channel is Talk Digital Network. If you have any questions for Ted or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.